away. I'm sorry.
You are fired. Do you understand that?
Don't overreact, Ted, please.
You're fired. I want you out of here now. Get out of here! Fired!
You'll regret this, Ted.
I regret it now. I've regretted it for the last 2 months.
You'll
fired
regret
too.
this.
You're out
As
of
the
here.
saying goes, the only thing certain in life is death and taxes. However, in recent years, another certainty has emerged: unemployment. It's a fact of life that everyone will experience at some point in their career, whether it's a temporary layoff or a permanent loss of a job. But how bad can unemployment get in America? The answer is, very bad. Unemployment is a cyclical issue that can be exacerbated by external factors, such as economic downturns, technological advancements, and globalization. When these factors collide, the result can be devastating for individuals and families. One of the most recent and significant examples of high unemployment in America was the Great Recession of 2008. The recession was caused by the housing market crash and the subsequent financial crisis, which led to the loss of millions of jobs and the bankruptcy of several major corporations. The unemployment rate soared to over 10% in October 2009, a level not seen since the early 1980s. The effects of the Great Recession were far-reaching and long-lasting. Many people who lost their jobs were unable to find new ones, and were forced to rely on government assistance or deplete their savings. Some were even forced to declare bankruptcy or lose their homes. The psychological toll of unemployment can also be significant, leading to depression, anxiety, and a sense of hopelessness. But the Great Recession was just one example of how bad unemployment can get in America. There have been numerous other instances of high unemployment throughout the country's history, including the recessions of the 1970s and early 2000s, as well as the Great Depression of the 1930s. In the Great Depression, unemployment reached a staggering 25%. This was a time of widespread poverty and suffering, as people lost their homes, their businesses, and their livelihoods. The psychological toll of the Depression was also significant, with many people feeling a sense of despair and hopelessness. So what can be done to prevent or mitigate high unemployment in America? One solution is to invest in education and training programs that help individuals develop the skills needed for in-demand industries. This can help individuals stay competitive in a changing job market and reduce the chances of losing their jobs. Another solution is to implement policies that promote economic growth and stability. This can include measures such as tax cuts, regulatory reform, and investment in infrastructure. These policies can help create jobs and stimulate economic activity, reducing the likelihood of high unemployment. Finally, it's important to have a social safety net in place to help those who are unable to find work or are facing financial hardship due to unemployment. This can include programs such as unemployment insurance, welfare, and job training programs. These programs can provide a lifeline for those who are struggling and help prevent the worst effects of unemployment. In conclusion, unemployment can be a devastating experience, with far-reaching and long-lasting effects on individuals, families, and communities. However, by investing in education and training, implementing policies that promote economic growth, and having a social safety net in place, we can reduce the chances of high unemployment and help those who are affected by it. The worst case of unemployment in history occurred during the Great Depression of the 1930s. This economic downturn was characterized by a sharp decline in global trade, a collapse of financial markets, and a widespread loss of confidence in economic institutions. The Great Depression had a devastating impact on the labor market, with unemployment rates reaching as high as 25% in some countries. The origins of the Great Depression can be traced back to the late 1920s, when the global economy was experiencing a period of rapid expansion. This expansion was fueled by rising stock prices, increased foreign investment, and growing consumer confidence. However, this prosperity was built on a fragile foundation of debt and speculation, and it was only a matter of time before the bubble burst. The first signs of trouble emerged in the United States, where the stock market crashed in October 1929. This event set off a chain reaction of financial crises and economic collapses around the world. As banks failed and businesses went bankrupt, workers lost their jobs and families struggled to make ends meet. The unemployment crisis was particularly severe in the industrialized countries of Europe and North America, where millions of people lost their jobs as factories shut down and demand for goods and services plummeted. In the United States, the unemployment rate reached 25% in 1933, with more than 15 million people out of work. In Germany, the situation was even worse, with unemployment rates reaching as high as 30%. The impact of the Great Depression on employment was devastating, and the consequences were felt for decades. Many people who lost their jobs during the Depression were never able to regain their footing, and many more were forced to work in low-paying, insecure jobs. The long-term effects of the Great Depression on employment are still being felt today, as people who experienced the worst of the crisis continue to struggle with poverty and social exclusion. The Great Depression was a turning point in the history of unemployment, and it served as a wake-up call for governments and policymakers around the world. In response to the crisis, governments implemented a range of measures to stimulate economic growth and reduce unemployment, including public works programs, job training initiatives, and social welfare measures. Today, the unemployment crisis is still a major concern for many countries around the world. While unemployment rates have fallen significantly since the Great Depression, millions of people are still struggling to find work, and many more are working in low-paying, insecure jobs. Governments and policymakers continue to grapple with the challenge of finding ways to create jobs and reduce unemployment, and the lessons of the Great Depression are still relevant today. The Great Depression was a devastating economic downturn that affected much of the world from 1929 to 1939. It was the longest and most severe economic recession in modern history, and it had far-reaching consequences for individuals, businesses, and governments around the world. There are many factors that contributed to the Great Depression, and no single cause can be pinpointed as the primary cause. However, there are several key factors that played a significant role in the economic downturn. One of the main causes of the Great Depression was the stock market crash of 1929. Prior to the crash, the stock market had been experiencing an unprecedented bull market, with stock prices reaching record highs. Many people invested heavily in the stock market, believing that the market would continue to rise indefinitely. However, on October 24, 1929, known as Black Thursday, the stock market began to crash. Prices plummeted, and many investors lost a significant portion of their wealth. This led to a widespread loss of confidence in the economy, and people began to withdraw their investments, further exacerbating the downward spiral. Another factor that contributed to the Great Depression was the high level of debt that many individuals and businesses had taken on in the years leading up to the recession. During the 1920s, many people had taken out loans and mortgages to buy stocks and real estate, believing that these assets would continue to appreciate in value. However, when the stock market crashed and real estate values began to decline, many people found themselves unable to pay back their debts. This led to widespread defaults and foreclosures, which further destabilized the economy. The collapse of international trade also played a role in the Great Depression. During the 1920s, international trade had been booming, with many countries importing and exporting goods on a large scale. However, when the economy began to decline, countries began to enact protectionist trade policies, such as tariffs and quotas, in an attempt to safeguard their own industries. This led to a decline in international trade, which further exacerbated the economic downturn.